If you have a 401k, there is a tax bomb waiting for you. If you have a 401k or traditional IRA, there is something called required minimum distribution, and it's gonna turn into a taxable event. And here's what you need to know about them in 90 seconds. Required minimum distributions are mandatory by the IRS at certain ages for you to start withdrawing out of your retirement account. The IRS is always gonna want their tax money, and so they force you to start taking money out of your retirement account so they can start collecting on those taxes. And so any traditional accounts, meaning any 401k, traditional IRA, 457B, 403B, SEP IRAs, simple IRAs, all of those types of accounts are going to have RMDs. But good news, Roth accounts, Roth 401k and Roth IRA no longer have RMDs. So when do these start? It's either 73 or 75 years old, depending on when you were born. You have to start withdrawing certain amounts from your 401k, and if you don't, they charge you a 25% penalty on top of the tax that you would have already paid. And every single RMD that comes to you is taxed as ordinary income, meaning could be 30, 35, 40%, not capital gains. And so there's a couple ways you can get around it. Number one is converting these accounts through a back door. You can actually convert your 401k into a Roth 401k or an IRA into a Roth IRA, and once they turn into Roth accounts, you no longer have RMDs. Now, this process is a taxable event, and so you have to be smart in the way you do it. You can also actually donate out of your retirement account and not have to pay taxes on this income. If you were to donate $100,000 out of your IRA, this donation will actually go to satisfy the RMD, and you don't have to pay taxes on it, making it a really good way to use the money if you're already going to give to charities. Whether you're in retirement or a long way from retirement, have a plan. So many people don't think about this until they're in retirement. At that point, it becomes a whole lot harder to start mitigating some of these fees and taxes. Know what your plan is in retirement. Start building that plan now, because what you don't want is to give 30, 40% of your retirement to the IRS because you failed to plan in your 30s and 40s. If you're looking for more ways to grow your net worth, follow me.